Well, around the world, we've been looking for returns. You haven't got much in Canada, and while North American stocks navigate choppy waters, there's a new hot market around the world. Investors have been flocking to Japan, buying over $15 billion worth of stocks in the last month alone. So far, the benchmark Topix has jumped almost 14%, and the Nikkei 225, which tracks Japan's blue chip companies, is up more than 18%, and it's definitely outpaced the S&P 500. For a look at what's driving some of this, Kei Okamura, who's a portfolio manager of Japanese equities at Neuberger Berman, is joining us now, where Neuberger manages about $436 billion of client assets. Thanks so much for joining us, Kei. Give us a sense of, you've been doing this for a while, just investor sentiment as it relates to, really a languishing market over the past couple of decades.
Yeah, no, you're absolutely right. This has been a market that has been overlooked, undervalued, underappreciated. Really has to do with the lost decades that I think everyone is very well aware of. But in the last sort of 10 years or so, there have been a number of corporate governance reforms that has really helped to sort of solidify and improve, many of the board structures in this market. But actually, the stock market, the way that is moved this year, really that's been a result of a catalyst that happened in March, which was the Tokyo Stock Exchange putting out a new set of guidelines to over 3,000 companies in Japan, asking management to improve transparency on how these companies will improve return on equity and return on invested capital above cost of capital. And this is actually a pretty big deal, because all these years, one of the reasons why the corporate governance reforms haven't really translated into a re-rating of the market has been because Japanese companies have not been running their capital management, their balance sheet, very efficiently. So that's depressed valuations. Now that the regulator has stepped in and pushing these companies to improve ROE and ROIC, it is starting to have an impact in the way companies are managing their surplus capital. So we're seeing lots of share buybacks. It's at a 16-year high as of the end of March, higher dividends, and all these actions are starting to gain the attention of the world as we speak.
It's also coming in a time where Japan is in this rare position of having probably the most accommodative major central bank, and inflation, which has been nowhere to be found again for decades, it has come up modestly by global standards. I know it's high by Japanese standards. Are these also becoming kind of macro tailwinds?
Yes, that is a very good point. So, the things that I mentioned earlier is sort of like the cream, but really, the fundamentals of the Japanese economy is looking very attractive as well. So, this year, a lot of the economic growth numbers that we've been seeing out of this market has been relatively good, and that has to do with resilient demand that's been supported by partly some government fiscal stimulus measures, but also the return of inbound tourists into Japan. So, walking around Tokyo, you'll notice that there's been a big pickup in the number of tourists coming back to this market. And what's really interesting is that, if you look at the latest stats as of April, we're probably back to about 70% of the tourist numbers pre-COVID. And this is all just from tourists, mostly Asia, some from the US and Europe, but surprisingly not China yet. So once we get more Chinese tourist visitors coming back in, we're going to continue to see more of that spending being supported domestically in this market. And then, as you mentioned, of course, the inflation picture continues to remain very subdued. We think this has to do with the fact that wages, they are picking up, but probably not the same level that we're seeing in the US, Canada, or Europe. And that is obviously making the job a little bit more difficult for the Bank of Japan. It means that they will likely keep accommodative policies for the foreseeable future.
Is there still upside, though? And I guess maybe from that question, we talk valuations, and is this still a market in which you can find bargains?
Absolutely. So, this market, as I mentioned earlier, underappreciated, undervalued. I mean, just to give you a couple of statistics, if you look at, say, like the mid section of this market, which is very liquid, by the way, Japan's the second most liquid market in the world after the US, roughly 15% of this market have zero sell side coverage. 70% of the market have less than five. The equivalent in the US and Europe is somewhere around 30 to 20 to 30%. So there's a lot of hidden gems in this market. A lot of these companies are riding on the same growth trends that are of the companies that we're seeing with astronomical valuations in the U.S., Europe, and in some parts in Canada as well. These companies, however, are trading at rock bottom valuations simply because they're just not understood or they're misunderstood. So often, we as long-term bottom-up investors, we dig up these companies, and we're surprised at the quality of these businesses and the growth potential that they have. But on top of that, I mentioned to you earlier that capital management is improving. This is one of the weaknesses of many of these Japanese companies. So we go in as investors willing to help these companies address some of these issues through engagement, and then they actually listen to us because many of these companies, they haven't been approached by foreign shareholders like us, and it's through that process that we're able to unlock value and get the valuations even higher.
And when you think about issues of, you mentioned becoming a little bit more shareholder friendly, but then there's also kind of the major topic of the day, which is artificial intelligence. And, the TSX, for example, we don't have much exposure to that. What is the tech exposure that you would be getting if you're looking to diversify away from the tech exposure just in the United States?
No, that's a fascinating question. Japanese economy has been traditionally more sort of geared towards the hardware side, whereas the U.S. and Europe has been a little bit more towards the software side. And chip design is more the U.S. and Europe, and then more the chip manufacturing, and then the materials that go into the chip manufacturing is more where Japan is. So we're riding on the same sort of trends, but I would say that the appreciation that we can expect to see in terms of the share price could be potentially a little bit at a lag, but that's okay. I mean, at the end of the day, these companies will benefit, and the beauty of it is that a lot of these companies are in very attractive positions of the value chain. So we have certain companies, they are, say, chemical makers that are used in the wafer manufacturing process, and they have astronomical market shares, like 70 to 80% global market share. That gives them great pricing power, and the ability to really come up with some attractive margins.